Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. The key message from FOMC overnight. The Fed is prepared to tolerate economic pain to bring inflation down to target. As expected, the Fed delivered a 75 bips rate hike, bringing the Fed funds rate to a range of 3% to 3.25%. But risky assets sold off as the details were hawkish. So let's take a look at the details. So first of all, there was increasing risk of stagflation, with downward revision to economic growth estimates and upward revisions to unemployment rate and inflation forecast. Following that, the dot plot, which is the FOMC members' projected policy path, moved up quite significantly. Now, the Fed funds rate is expected to peak at 4.6% in 2023. That's up from 3.8% in the June estimate, before moving down to 3.9% in 2024. Which is in turn 50 bips higher than the June estimate. At this stage, it almost means that a second half pivot next year is unlikely to happen. Recall that was one of the key negatives to risky assets that I mentioned in the podcast yesterday. Finally, during the press conference, Jay Powell basically gave the message that economic growth would need to be brought down below its trend level in order to rebalance supply and demand in the US economy. And he would like to bring inflation back down to the 2% target. So there's likely to be another 125 bips rate hike over the coming two meetings, which highlights their intention to bring the policy rate to restrictive territory very fast. Now, risky assets continued their recent weakness and sold off overnight. When will we see a reversal to this downward trend? We need to see evidence of inflation going below expectations again in order to reignite potential of the yields coming off from elevated level, which would help risky assets. But until then, stay defensive. Like we said, it is very imperative for investors to balance income and growth in their portfolio through rotating into assets such as high dividend equities and DMIG corporate bonds. In such an environment, quality and steadiness in earnings will be heavily sought after. That's quite different from what we saw in the low yield environment that we're used to since the beginning of QE. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.